Welcome to the deep dive. We're here to take that huge stack of sources and really boil it down, giving you the absolute essentials you need to grasp a really big topic fast.
And today, wow, we're stepping right through the looking glass into Enron, the spectacular implosion. Predictable, maybe, in hindsight.
Yeah, maybe.
And we're not just, skimming the surface with the accounting tricks. We're going deeper into the culture, the organizational mindset that, well, actively chose image over actual reality.
It's quite a contrast, isn't it? You see these images, Ken Lay shaking hands with presidents, Enron slapping its name on a $100 million stadium,
Oh, yeah.
Jeff Skilling being called this like oracle of corporate strategy.
Yeah.
And then you look at what our source material shows was actually happening inside. It's just staggering. A deep, deep internal rot.
Exactly right. So our mission today, let's quickly unpack the key players here. The financial strategies they used, incredibly risky stuff. And maybe most importantly, the sort of moment-to-moment ethical compromises, the small decisions that added up that let this, $70 billion giant just crumble.
Right. How did it happen? How did ambition just blind these incredibly smart people?
That's the question. And it really has to start at the top, with Ken Lay.
His rise was something else, very quick, moving from government regulatory jobs, deputy undersecretary of energy, that kind of thing.
Yeah, Federal Power Commission too.
Right.
Yeah.
To running Transco, which, well, became the core of Enron. But the sources, they show these patterns of, let's say, calculated maneuvering, even really early on.
Oh, absolutely. It's fascinating, the sheer boldness. One source details how Lay learned to, exploit his former boss's temper, a guy named Sullivan.
Exploit his temper. How does that work?
Well, Lay apparently figured out that Sullivan had these huge temper tantrums, like really big blow-ups.
Okay.
But they were always followed by this period of intense guilt, contrition. So Lay would intentionally provoke him, get him angry.
Seriously.
Yeah. And then, during that apology phase, when Sullivan was feeling bad, vulnerable, that's when Lay would bring forward the big complex decision he wanted approved. He weaponized guilt, basically, to bypass real scrutiny.
Wow. That sets a certain tone for leadership right from the start, doesn't it?
Yeah.
Emotional leverage over open discussion.
Definitely. But to be fair, Lay did bring some genuine innovation, too, early on.
The spot market for gas, right?
Exactly. At Transco, he and his team came up with this idea. Let's have a spot market for natural gas. Let's ditch the old regulated system, the fixed long-term contracts. It was revolutionary, really. A market-based approach, a big step for the whole industry.
Okay, so innovation, but also manipulation.
Yeah.
And then the seeds of trouble really start spouting.
1987.
To the Hala.
The oil trading scandal.
Oh, the Hala. Such a huge red flag. And the company just waved it away.
Seems unbelievable now.
It was this clear sign that the corporate tolerance for risk was just, out of control. Lay ignored repeated warnings, internal warnings, mind you. People like Mike McElroy saying, hey, these traders, like Louis Bourget, they're way over their limits. They were risking, get this, $1 billion in potential losses.
$1 billion. With a B, back in 1987.
Yeah. Now, they managed to resolve it for an $85 million after-tax loss. Sounds manageable, maybe. But the real cost wasn't just the money. It was the loss of credibility. And the lesson Lay completely failed to learn.
What was the lesson he should have learned?
Well, he stood up in front of everyone afterwards and said, and this is almost a direct quote, "We will never again risk Enron's credibility without first making sure we thoroughly understand the risks." A solemn promise, publicly made.
And promptly broken.
Immediately broken by the culture he fostered. He learned how to manage the fallout, the PR crisis, not the actual risk.
Okay, so that failure to learn, that focus on image over substance, it leads us straight to the next key figure. The real catalyst, maybe. Jeff Skilling.
Skilling, yeah. His background is pretty wild, too. I mean, fixing up a TV station at a Moose Lodge, then studying these really obscure investments after a business failure, which somehow lands him at McKinsey.
And at McKinsey, he comes up with the idea that really transforms Enron, the gas bank.
Brilliant concept. Simple on the surface. Enron acts as the middleman, guarantees supply, guarantees price, sometimes for decades. Producers are like depositors, customers are borrowers. Skilling could walk in and offer a 20-year gas contract at a fixed price, say $2.20 per MSRF. That kind of stability, it shocked the market. People snapped it up.
Okay, but here's where the genius starts to curdle, right? The gas bank concept became the foundation for the fraud because of the accounting. Skilling pushed hard for mark-to-market, MTM. Let's unpack that because it's absolutely crucial.
It really is. Mark-to-market accounting, MTM, usually used by trading houses, right? It means instead of recording the revenue from that 20-year contract bit by bit as the cash actually comes in,
Which seems logical.
you record the entire estimated value of that deal, including all the projected future profits, the second the contract is signed. Day one, boom, huge profit number.
That just sounds like, well, financial fantasy. What's the danger baked into that system?
The danger is it completely disconnects your paper profits from the actual cash you have. The sources hammer this point. MTM generated high earnings and low cash flow. You book maybe hundreds of millions in profit in one quarter from one big deal.
So you look amazing to Wall Street.
Exactly. But the actual cash from that deal, it might not show up for 10, 15, 20 years. Your bank account is comparatively empty.
Which creates this immense pressure cooker inside the company, I imagine.
It creates an addiction, a treadmill. To keep showing that incredible double-digit growth that Wall Street and, frankly, Ken Lay demanded, Enron had to sign more and more massive deals every single quarter, bigger and bigger numbers.
Because if you stop signing new deals,
Your earnings growth just stops, flatlines immediately. It turned the whole company into this machine, fueled purely by projections, constantly needing more deals to feed the beast.
a beast generating theoretical profit, but real cash flow problems. And that kind of machine, it needs a special kind of mechanic to keep the numbers looking good, right? Which brings us to Andy Fasto, the CFO's corner.
Right. Segment 2. Enter Andy Fasto. He had the credentials, Kellogg MBA, Tufts undergrad, married into the wealthy Weingarten family in Houston. Looked great on paper.
But he didn't quite hit the ground running at Enron.
No. He initially failed in the retail energy unit. Skilling apparently told him something like, look, this isn't what I need from you. Pretty blunt.
Ouch. But Fasto, he adapted.
He pivoted big time. Instead of leaving, he carved out this new role for himself, financial engineer-in-chief. And his new mission, create these off-balance sheet vehicles, special purpose entities, SPEs, specifically designed to help Enron's managers hit their budgeted profits.
By hiding debt.
Primarily, keep debt off Enron's main balance sheet to make the company look healthier and less leveraged than it really was. This led straight to the infamous LJM funds, LJM1 and LJM2.
And the structure itself, you called it diplomatic earlier, but it wasn't just a red flag. It was a screaming siren, wasn't it? Yeah. An unbelievable conflict of interest.
It really was. LJM was set up as this separate partnership. But who are the investors? Andy Fasto, Enron's CFO, Michael Copper, his top lieutenant, other Enron execs. So you have the chief financial officer of Enron.
Starting an outside fund.
That is negotiating deals with Enron. He's on both sides of the table. How does a board even approve that? The CFO negotiating against his own shareholders.
And what was the justification? There must have been some story they told themselves, right?
Oh, Fasto's justification was pure arrogance, really. He basically argued, look, I know Enron's assets better than anyone, so my outside fund, LGM, can do these deals faster, more efficiently. It saves Enron money. Supposedly.
It's inventive.
It was perverse. One of Enron's own tax lawyers, Jordan Mintz, apparently described it privately as justifying incest. That quote just nails the ethical bankruptcy of it.
It really does. But the danger wasn't just the conflict, as bad as that was. It was what LJM actually did, especially with those structures called the Raptors.
Ugh, the Raptors. LJM 1 and 2 set up these 4 SPEs called Raptors, their stated purpose, to hedge Enron's riskier merchant investments. Things Enron owned outside its core energy trading. Remember that massive windfall they got from the Rhythms Net Connections IPO?
Yeah, the dot-com bubble was inflated.
Exactly. So Enron had all this Rhythm stock, very volatile. Raptors were supposed to protect Enron if the Rhythms stock price fell. Hedging. Sounds responsible, right?
On the surface, sure. But this wasn't a real hedge, was it? It was something much, much worse. Financial self-destruction, almost.
You got it. The sources lay out the mechanics clearly. LJM, through the Raptors, was supposed to pay Enron if Rhythm's stock tanked. Okay? But how is LJM guaranteeing that payment? What was the collateral?
Well, tell me.
Restricted Enron stock. So think about that. If Rhythm stock crashes, LJM owes Enron money. But LJM's ability to pay Enron depends entirely on Enron's own stock price staying high or even going higher to ensure the collateral is worth enough.
That's not a hedge. That's just doubling down. It's a gigantic structural bet that Enron's own stock will never fall. If Enron stock did fall, the hedge collapses, and it actually makes the fall worse because the collateral loses value.
Precisely. Vince Kaminsky, Enron's head of risk management, a really smart guy, he saw right through it. He called it what it was, just a massive bet on Enron's stock price, not a hedge at all.
And while this incredibly risky structure is being built, undermining the entire company, Fasto is personally cleaning up.
Oh, yeah. He told the board himself he made, what, $45 million combined from LJM1 and LJM2?
$45 million. And what did he tell the board about the time commitment for running these funds?
He promised it would take no more than 3 hours a week of his time.
3 hours a week for $45 million. While being CFO, that compensation completely detached from any real value created for Enron shareholders, it just screams about where the company's priorities were.
It screams about the incentive structure, doesn't it? Fasto was rewarded, handsomely, for engineering the illusion, for managing the numbers, not the actual underlying business reality.
Which leads us perfectly into segment 3. The warnings ignored and this culture of fear. Because the truly tragic part of this story, when you read the sources, is that the truth was known inside Enron. People saw this coming. It wasn't some big secret.
The internal resistance, it was definitely there. You had people with real integrity pushing back hard. Cliff Baxter, he was a big deal maker known for being blunt. He apparently walked into a meeting about one of these structures and just said, I don't like this one fucking bit. It's not clean.
Strong words, but ignored.
Marginalized. You also had Vince Kaminsky, the risk expert we mentioned, the guy who saw the Raptors bet for what it was. He didn't just identify the problem, he warned management about a potential cascading series of triggers.
What did he mean by that?
He predicted the exact death spiral that happened. He said, look, if the stock price starts to fall, it could trigger debt covenants in these complex structures. That forces asset sales or demands for more collateral, pushing the stock price down further, which triggers more covenants, potentially leading to a credit downgrade to junk status. He literally mapped out the company's collapse mechanism.
And nobody listened. How is that possible?
That kind of detailed expert warning, it should have stopped everything. Cold. But the culture. It was toxic to bad news. You didn't bring problems to Lay or Skilling. You brought solutions, or you kept quiet. Even the external auditors got compromised.
Arthur Anderson, the accounting firm.
Yeah. There was a guy at Anderson, Carl Bass, from their internal professional standards group, kind of like their own quality control. He raised serious questions about Enron's deals. So what happened? Rick Causey, Enron's chief accounting officer, complained that Bass was caustic and cynical toward their transactions.
Caustic and cynical, isn't that what you want from an auditor sometimes? Skepticism.
You'd think so. But Causey got Bass sidelined. Essentially, Enron shopped for auditors who would bless the deals, not challenge them. They wanted cheerleaders. And don't forget, warnings went straight to the top. To Lay himself. Rebecca Mark, she ran Enron's international division, a major figure. She personally warned Ken Lay that Jeff Skilling did not have the same, quote, ethical bearing as the rest of the company.
A direct warning about Skilling's ethics to the CEO.
Yes. But Skilling was protected. He was the architect of the growth story, the high stock price. Questioning Skilling was like questioning the magic.
So let me get this straight. You have internal risk experts warning of structural collapse. You have senior executives objecting on ethical grounds. You have auditors raising red flags. How did Skilling keep operating with such impunity? What stopped Lay from stepping in decisively?
Lay was just deeply, deeply invested in the narrative, the growth story, the rising stock price. Skilling delivered that narrative. Challenging Skilling meant challenging the entire edifice, the stock price, everything Lay had built his reputation on. But even Skilling, the master illusionist, couldn't sustain it forever.
The pressure became too much. The sources describe a breakdown, right?
Yeah, a serious emotional breakdown. Found in his office, apparently wide awake, but in a state of just wild-eyed terror, shouting at his fiancée, Rebecca Carter, things like, "Get the fuck away from me." The fiction he'd constructed, it seems, just consumed him.
And then he quit, abruptly. August 2001, what was his public reason?
The official line was basically, personal reasons or, I'm not having fun anymore, which is quite something for a CEO.
Not having fun.
But later, a reporter asked him point blank, if Enron's stock price had still been soaring, would you have stayed? And Skilling's answer gave the game away. He said, I guess so.
Wow. So the fun was the stock price, the illusion of genius.
That seems to be it. So Skilling walks out. Lay steps back in as CEO, but he seems completely oblivious to how bad things really are. Skilling assured him, no accounting issues, no trading issues, everything's fine.
And this is right around the time Sharon Watkins sends her famous anonymous letter, isn't it? The whistleblower memo.
Exactly. Watkins warns Lay that Enron is about to implode in a wave of accounting scandals. But Lay may be focused on the management change, on projecting stability, on everything but the complex accounting. He seems to have missed the real smoking gun. The core problems with LJM and the Raptors, he didn't grasp the accounting time bomb.
And so the clock runs out, segment 4, the ticking clock and the final days. The company just couldn't fake it anymore, couldn't pay its bills with inflated stock.
Nope. The credit markets slammed the door shut. The commercial paper market, which Enron relied on for short-term cash, just stopped rolling over its debt. Suddenly, cash was king, and Enron realized it had almost none.
And then came this final, brutal surprise, the rawhide debacle, something nobody in senior management apparently even knew about.
It's an incredible detail, isn't it? Shows how complex and opaque these structures Fasto built really were, even internally. Suddenly, they discover this obscure provision, a debt acceleration trigger, buried in a structure called rawhide.
What did it do?
It meant that because of some other financial event, maybe a credit rating trigger they didn't anticipate, Enron suddenly had to repay $690 million. Immediately, like within 15 days.
$690 million they didn't have.
Exactly. Jeff McMahon, who later took over as CFO, was apparently stunned. His reaction, according to the sources, was something like, wait, we've never done deals where we allowed debt acceleration while we're still investment grade. That's only for jump-rated companies.
So that discovery itself must have terrified the banks. It revealed Enron's debt was far riskier than its public rating suggested.
Killed confidence overnight. That realization was the final nail in the coffin for banker support. The end game started right there.
And it came fast.
Very fast. Lay, who had placed so much trust in Fasto, finally had no choice. Bankers were flat out refusing to deal with Enron as long as Fasto was CFO. So Fasto was put on leave, McMahon replaced him, but it was far too late. The ship was already sinking.
And Lay, in desperation, starts making calls.
Yeah, calling in old favors, or trying to. He called Alan Greenspan at the Fed, called Treasury Secretary Paul O'Neill. Lay knew these guys from his political networking days.
Did he ask for a bailout?
Not explicitly, according to the sources. He just informed his old friends how, quote, dire the situation was, letting them know the potential fallout. But the implication was obvious. Help us. They didn't bite. The government, watching this train wreck, essentially decided to let the market handle it, no intervention.
And then just chaos.
Yeah.
People shredding documents.
Yeah.
That infamous email from Nancy Temple, the in-house lawyer.
Right, telling employees to make sure they were complying with the company's document retention policy, which, in that context, everyone understood as a thinly veiled instruction. Get rid of incriminating stuff. Now.
The stock price craters. Wipes out employee 401k, pensions. Thousands of people lost everything. And the company files for Chapter 11 bankruptcy. December 2nd, 2001. Just gone.
Leaving behind this massive crater of mistrust, changing corporate governance, regulations like Sarbanes-Oxley, its legacy is huge, born from this incredible failure.
So let's step back, distill it down. What are the absolute core takeaways from our dive into these sources? It seems like 3 pillars of failure stand out. First, that deliberate choice. Prioritize the fiction of mark-to-market earnings over real cash flow. It created this corporate addiction to impossible growth.
Absolutely. Second, the introduction of those devastating conflicts of interest, LJM, allowing the CFO to essentially prey on his own company, negotiating against the shareholders he was paid to protect. It's just structurally corrupt.
And third, maybe the most shocking, the absolute refusal of top leadership Lay, skilling the board to listen to their own internal experts. They had the warnings, the risk analysts, the lawyers, the executives who saw the problems clearly. They chose denial every single time, until it's too late.
Which really brings us to a final provocative thought for you, the listener, building right off that source material. We've seen the documents prove it. The warnings were there. Precise expert warnings available inside Enron from their own highly paid, very smart people. So given that the knowledge was available, why? Why were the leaders, Lay, skilling the board, so incredibly resistant to believing the bad news? Right up until the moment of literal collapse. What does that tell you about the sheer power of a seductive corporate narrative, that story of genius, of unstoppable growth, to blind even the very smartest people to the cold, hard facts right in front of them?
Question that definitely echoes far beyond Enron. Thanks for joining us on this essential deep dive into the source material.
Yeah, thank you. Until next time, keep digging into those complex topics and keep asking the tough questions.